Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to adjust for unrealized profit on the transfer of non-current assets between the parent and the subsidiary. Now let's look at the question. Now for this question, it's an extract from a full past question. So I've made the extract to just explain the concept of how we adjust for the unrealized profit. So let's see the details. On 1st October 20x0, Prodigal purchased 75% of the equity shares in Sentinel. The acquisition was through a share exchange of 2 shares in Prodigal for every 3 shares in Sentinel. The market value of Prodigal shares at 1st October X0 was 4 per share. Now the summarized profit or loss and OCI for the year ended 31st March 20X1. So if you reconcile these to the year end, that tells you 6 months since acquisition. And it's important you note that. Now we have revenue, we have cost of sales. Now our main adjustment would be around cost of sales. Now the additional information which is relevant is that immediately after the acquisition of Sentinel on 1st October 20x0, Prodigal, remember Prodigal is the parent, transferred an item of plant with a carrying amount of 4 million to Sentinel at an agreed value of 5 million. At this date, the plan had a remaining life of 2 years, of 2.5 years, so 2.5 years. Prodigal had included the profit on this transfer as a reduction in depreciation cost. All depreciation is charged to cost of sale. So what it means is that in making adjustment for the cost of sale, so let's say the cost of sales, so we have as per the question. So in consolidating it, we have 260 plus 110 times 6/12. So because we term a portion, so 110 times 0.5 plus 260, that should give us 315. So on this basis, we can adjust for the unrealized profit. So I'll put here the provision for unrealized profit on the plant. Now, 2 ways you can calculate this. You can find the total profit on the sale, and then you less what we call excess depreciation. So I'll work the 2 ways, and then you decide which one you are comfortable with. So I'll look at the first one, is to find the total profit. So total profit on sale, and that should be the 4 million from the 5 million. So this is 5 minus 4, and that should be 1,000. Now the excess depreciation would be the depreciation with transfer. So with transfer value, and what that would be is the 5,000 divided by 2.5 years, because we had the plant having a remaining life of 2.5 years, times 6/12. And then I'll do another one and say depreciation without transfer. That is to say, I'm considering the carrying amount. So i.e. the carrying amount. So that would be 4,000 divided by 2.5 times 6 over 12. So let's check. 5,000 divided by 2.5, yes, times 6 divided by 12. That gives us 1,000. So here is 1,000. So let me just write it here. It's 1,000. And the 4,000 divided by 2.5, also times 6 over 12, that is 800. So I'll less it. So the excess depreciation would be 200. And then let me just push this a bit. So here, now the excess depreciation, I'll have to deduct it from the total profit. And when I do that, I'll have a net of 800. And that 800 becomes the unrealized profit. So the unrealized profit here have to be added to the cost of sales so that the adjusted, so we can have the adjusted cost of sales. Now, the second approach is to work the carrying amount. The second approach to find the unrealized profit on the plant is to find the carrying amount we transfer. So what you do is 5,000 less the depreciation, and the depreciation should be 5,000 divided by 2.5 times 6 over 12, and our less carrying amount without transfer. Very simple. It's 4,000 minus 4,000 divided by 2.5 times 6 over 12. And remember, when we were doing the first option, we had the depreciation to be 1,000 for the first one. So the current amount, if this is 1,000, the current amount will be 4,000. And we had the depreciation here to be 800. So if this is 800, the current amount here should be 3,200. And when we deduct this from the total current amount, the net will be 800. And this 800 will be the unrealized. Let me just make it PURP on the plant. And this will be added to the cost of sales. So notice that here we had 800. If we do it the excess depreciation approach, we had 800 again. So the 800 here will be added to the adjusted cost of sales to have the value. So this is how we account for the unrealized profit on an asset transferred in the post-acquisition period. Remember to time apportion it if it is less than 12 months. Please, I hope this helps you in your preparation for the exam. Remember to subscribe to this channel to receive updates on new videos.